In today's episode of the MSA Rental Market Update, we are looking at the Fort Collins rental market for multifamily properties, more specifically, conventional apartments. So you can kind of get an idea of where the Fort Collins metro statistical area is located, just to the north of Denver and just to the south of Wyoming. We see Cheyenne, Wyoming here. We have Nebraska on the northwestern corner. We have Kansas down here to the east, or northeastern corner. Kansas down here to the east, and we got Salt Lake City, Utah to the west. And one of my favorite spots in this country is Jackson Hole, Wyoming, up here in the Teton National Forest. So, that said, let's go take a look at our filters for the Fort Collins metro statistical area. As usual, we are excluding all corporate, all military, all senior, and all vacation, and we are only including market and market affordable. We are not looking at any individual asset class to begin with. We're looking at all three combined. Then we'll look at each one individually, Class A, Class B, and then Class C. If we go to location, we can see that we are in market, metro statistical area, and Fort Collins, Colorado. At the end of this video, when I go to plot this on the market cycle chart, make sure you stay to the end and I will let you know where we see the Fort Collins, Colorado area on the market cycle chart. With that said, let's go take a look at the analytics for all three asset classes combined. So here is our supply side snapshot. There are only 455 conventional apartments in this small metro statistical area, totaling 18,710 units. There are currently 695 units under construction, and in the last 12 months, 827 have absorbed. In the prior 12-month period, so back to 2021, 875 absorbed. So this is the strongest absorption we have seen to date. We have not seen anything this strong. And look at our vacancy, only from 4.9 to 5.1. This tells me that this market is sustaining even at these high rents. So it does have a year-over-year rent growth of 4.5%. We'll see what it looks like quarter over quarter. But I'm going to have to guess, just by looking at this absorption data, it's not going to be too terribly bad. As usual, we do not look at the capital markets. We only look at the space market. So if we come down, we can see that our long-term occupancy average is about 94.5%, and we are sitting about 95%. So we're on the long-term occupancy average, but on the top side of it. And there's a good chance here that I may plot this. We'll see what rents are doing, but I may plot this a little higher on the oversupply phase, maybe even closer to equilibrium. Just by looking at this snapshot, this market seems to be sustaining right now. But we can see that this market really only operates between about 92 and a 2/3% to about 96.5%. So even at 94.5, that's pretty small of a window. So we don't have a whole lot of room to negotiate one way or the other. So just little changes can make a big difference in where we put it on the market cycle chart. So let's go look at our data and see what our data is telling us for all three asset classes. So here's the rent analytic data. We are not looking at asking rents. We don't care what the owners are asking. We only care what they are collecting. So if we look at quarter one, it was $1,557 of the first quarter of 2022, went up to $1,647, and interestingly enough, went down to $1,599 and then down to $1,585. Now it is showing an increase for the month of January. I think we can start to look at January's numbers. CoStar has reported that their January data is accurate. So if that is the case, then we can say that there was an uptick in rents from the fourth quarter to January. So let's go take a look at our construction, deliveries, and absorption and see what we see there. So we had 283 deliver in the first quarter, only 74 absorbed, so a little weak there. Then we had 160 deliver and 102 absorb, again, a little weak. Then 261 deliver and 213 absorb, that's nice. And then no deliveries with 71 absorption. So we got positive absorption there. And then 375 units deliver and another 412 absorb in January. So interestingly enough, we can see that we had occupancy ticking down, but now it's on its way back up again. So very, very interesting. And this is why we saw that rent increase in January of 2023. So it looks like overall, this market is reacting appropriately to demand supply fundamentals. Let's go see what the Class A story is telling us. Here is our Class A rent analytic data. There are only 29 properties totaling 6,079 units in the market. Looking at effective rent, it started at $1,737 in the first quarter, went up to $1,845 in the second quarter of 22, and then down to $1,790, down to $1,754, and then for the month of January, back up to $1,786. So much like we saw in the overall market. So let's look at deliveries and absorption, and we can see there really weren't any deliveries other than 261 units, and it absorbed pretty close to all of them. Actually, it did absorb all of them, and in an additional 17 units in the first month. So we had a +1 absorption in the Class A space for the amount of absorption to delivery. So nice and strong holding absorption in the Class A market. So once again, reacting appropriately to demand supply fundamentals. We can see we had an uptick, then a downtick, then stable, and then an uptick. So we are at the same occupancy now that we were in the fourth quarter of 2022. So this market is stabilized as it sits right now. So let's take a look and see what the story of the Bs are telling us. Here's our Class B rent analytic data. We have 63 properties totaling 6,542 units. Looking at effective rent, we started the first quarter at $1,584, went up to $1,690, down to $1,627, down to $1,616, and then up to $1,649 in January. So same exact tale we saw with the other two data sets. Let's see how deliveries and absorption react. So we had 252 deliver in first quarter, only 22 absorb, and we had a downtick big time in from fourth quarter 2022 or fourth quarter 2021 to first quarter 2022. And that is in line with the little number of units that are in this market, with only 252 units delivering. Then another 160 units delivered and only 71 absorbed, so that occupancy ticked down again. But then third and fourth quarter and going into first quarter or first month of 2023, real strong absorption, bringing that occupancy back up again to higher than what it was in the first quarter, but still below what it was in the fourth quarter of 2021. So good, strong numbers in the last three quarters for absorption, which explains why the rents ticked back up in the month of January. So Bs, once again, reacting like the As and like the overall, where our demand supply fundamentals are working as advertised. Let's see if the Class C space tells us a different story. Here is the Class C rent analytic data. There are 335 properties totaling 5,680 units. Looking at effective rent, we were at $1,161 in the first quarter, $1,188 in the second quarter, down to $1,179 in the third quarter, up to $1,200 in the fourth quarter, down to $1,190 in the first month of 2023 for January. So we got a little roller coaster action going on. First time we've seen this. Let's look at absorption and see what it's telling us, because we should not have deliveries or construction, and we don't. So if we look, we can see that we have some positive absorption, then negative, then positive, then negative. So because of that, we've seen a little waffling of the occupancy. Now we are below what we were from the first quarter now, and we've ticked down a little bit, which explains that little bit of a downtrend. So The Class C market, which seems to be sensitive to the absorption for rents, is doing exactly what it's supposed to do for demand-supply fundamentals. So that said, overall with this market, whether it's A's, B's, or C's, they are reacting to the fundamental principles of demand-supply. If absorption is strong, the rents are increasing. If absorption is weak or negative, they are decreasing, and that's exactly how it should happen. So this market is holding its own. It's kind of teetering a little bit. So if we pull up the market cycle chart, because we have such a very small window for our long-term occupancy, what do we have, 93 and 96, and we're kind of sitting right in the middle somewhere for that long-term occupancy average. Really, it'd be this direction. So we're definitely in the oversupply phase above the long-term occupancy average. I know that long-term occupancy average showed us about right here, but rents are ticking back up again, and absorption is pretty strong in 2 of the 3 asset classes. So that said, honestly, I'd put the Fort Collins, Colorado MSA probably at this point in the oversupply phase. I may even move it back to equilibrium because it's kind of teetering back and forth. There are still a few units left to deliver in the market, but there aren't a whole lot of units in this market to begin with. So any new delivery does affect the vacancy and does affect the rents. But if this absorption keeps up, then we're probably going to stay up here just to the eastern side of our equilibrium line. All right. So Fort Collins, Colorado, holding strong, probably one of the strongest markets we've seen yet. No surprise there. It's a smaller market and has good fundamentals. So will it break later? I don't know. We don't have any signs showing us it will because it seems to be bouncing back. But as interest rates continue to climb and as inflation continues to climb, we'll see how it will affect this market. That does it for the Fort Collins rental market update. Stay tuned next week, where we will start the week on Monday with Austin, Texas. Tuesday, we will do San Jose, California. Wednesday, we'll do Richmond, Virginia. Thursday, we'll do Greenville, South Carolina. And we will finish the week in Fort Myers, Florida. So it'll be interesting to see if we can see some data from the hurricane and how that has affected the Fort Myers area. So we get to finish the week next week with that. That said, have a great weekend, and we will see you in Austin, Texas next week.